So many places around the globe has relaxed their standards when it comes to social distancing and when it comes to reopening. This is causing a spike in some coronavirus cases. As such, I want to speak to you today about something the IRS has done through the CARES Act that gives a provision for taxpayers that are harmed by COVID-19 to be able to access money from their retirement plans. They provided an update on this yesterday, and I'm going to speak specifically to this today and give you some ideas on possibly how to maximize your IRA during this time. Stay tuned, we're going to talk about all of that next. Hello everyone, my name is Paul Zachary Shelton Jr. and I'm the Chief Investment Officer of Ward Shore Advisors. We are a wealth and investment management firm located in Orlando, Florida with clients all across the United States. If this is your first time coming to my channel, I ask that you please hit the subscribe button, please ring the bell so that you can get an update each time I upload a new video about all things financial. As well, please like and share this video. That's very important to me. It helps me reach my goal of increasing the financial literacy of this globe. Thank you so much. And before I get into today's topic, I want to offer you a free financial planning cheat sheet. This cheat sheet will provide you with a snapshot of what your financial health looks like as of today. As well, it'll give you some building blocks that you can use to increase your overall financial health, as well as investment allocation that you can use right now to invest in our current landscape. So, as of yesterday, the IRS posted an update on their website regarding the CARES Act and how IRAs and qualified plans are treated under there if you need to take a distribution or if you have a loan that's pending. So as we all know before, and I advised it before, that the CARES Act provided relief for qualified investors to treat distributions up to $100,000 made from an eligible retirement plan. This includes IRAs between January 1st and December 30th of this year. Historically, whenever you take a distribution from an IRA, if you're under the age of 59 and a half, you do have a 10% penalty that you will have to pay for taking that distribution. As of right now, that is being waived if you're making that distribution because of a coronavirus related event. Now, this is what they expanded upon, or expounded upon, whichever is correct there, most recently. So the IRS has given us new guidance on what a qualified individual is and who really qualifies now to be able to take this distribution from the 401K, the 403b, IRAs, all those qualified plans out there. So a coronavirus related distribution is not subject to the 10% additional tax that otherwise generally applies to distributions made before an individual reaches the age of 59 and a half. In addition, a coronavirus related distribution can be included in income in equal installments over a 3-year period. An individual has 3 years to repay a coronavirus-related distribution to a plan or IRA and undo the tax consequences of the distribution. This is directly from the IRS website. So speaking to what I said before, and in addition to that, you are still going to be taxed as ordinary income on the distributions that you take from your qualified plans. The IRS is giving you 3 years to qualify this income over the plan. So if you take out $30,000, you can qualify $10,000 on each year and have it be paid out on a taxable basis over that time frame. Or additionally, if you were to pay back the money, you take it out and say, okay, for whatever reason we really didn't need it, or you take out $30,000 and you only use 20 of it, you can take that $10,000 that's remaining, put it back into the plan, and abate the taxes for that situation altogether. In addition, the CARES Act provides that plans may implement certain relaxed rules for qualified individuals relating to plan loan amounts and repayment terms. In particular, plans may suspend loan payments that are due from March 27th through December 31st of 2020. And the dollar limit on loans made between March 27th and September 22nd of 2020 is raised from $50,000 to $100,000. So this is different from what was announced before. Previously, we were only able to take out a loan up to $50,000 of your from your retirement plan account or any plan account that you have. You were only able to take up to $50,000. Now you can that has been increased to $100,000. This is very significant in a time where many people are still struggling financially and need assistance financially. The likelihood of another economic stimulus payment going out to individuals is kind of waning in the balance right now, and it's not a lot of momentum behind it. So this is another way where you can kind of access some additional funding and access money that you may need during times where it's very, very hard financially for everyone. So on yesterday, the IRS expanded the definition of who qualifies to take distributions or to take loans from a qualified account or 401K without penalties. And this is all without penalties. So the first one is someone who is diagnosed or whose spouse or dependent is diagnosed with the virus and they have provided a test that has been approved by the CDC or a test that's been approved by the Federal Food, Drug, and Cosmetic Act. Secondly, someone that experiences financial hardship or consequences as a result of the individual or the individual's spouse or a member of the individual's household. This is someone who shares the individual's principal residence. So these are the second cases. So if you were diagnosed, you had a dependent that was diagnosed, or your spouse was diagnosed with the coronavirus, you qualify. Or the second case is if you're experiencing any financial hardship or any financial consequences as a result of anyone in your household that was diagnosed with the virus, then you'll qualify. And some of the things that they define under that is someone that is being quarantined or being furloughed or laid off or having work hours reduced due to COVID-19. Many people fall under this category. A lot of people have been furloughed, laid off, or had work hours reduced. And another thing that you can look at is many people had a second job, or there were two jobs, maybe had a full-time job and a part-time job. It's very possible that if your full-time job stayed open and you're still working that full-time job and that part-time job, if you were per diem like a nurse, you may not be called in to that part-time job as much. That counts as a reduction in work hours from what you're typically used to on a monthly basis. So you would qualify under that respect for this. Additionally, being unable to work due to a lack of childcare due to COVID-19. Many childcare facilities have closed, and we're running really skim and really thin back in the month of May. As of June, things have started to reopen all around the country. A lot of childcare centers have reestablished a good base and starting to pick up. I know the daycare that my son, my 3-year-old, was going to only literally had like 6 kids back in April. And it was very thin, very slim. So that's another one. The next is closing or reducing hours of a business that they own or operate due to COVID-19. So this is starting to speak about the self-employed individuals out there. So if you have a business that you own and as a result of the virus, whether it's a direct relation with being able to run or operate your business from a socially distancing standpoint, or if it was due to impacts from a lack of revenue. But if there was anything that caused you to close the business or have reduced hours of your business to operate, then you would be eligible to qualify, for this. Having to pay our self-employment income reduced due to COVID-19, again, falls under the self-employment here as well. So if your pay was reduced or your self-employment income was reduced, you're eligible to fall into this category now as well. And lastly is having a job offer rescinded or a start date for a job offer delayed due to COVID-19. Many people out there, the economy was moving well in January and February. They received job offers and they were notified that they're going to have to hold off on this job offer. They're going to have to delay it because of COVID-19. So if you fall into that category where you receive a job offer and it's been delayed or it's been rescinded as a result of the coronavirus, then you would be able to go ahead and access any retirement plans or any IRAs that you have and pursue either the loan or the distribution in that respect. If you have any questions about anything that I mentioned here previously or any questions about estate planning or investing, please reach out to me directly at investments@warwickshore.com. We are a wealth and investment management firm located in Orlando, Florida, with clients all across the United States, and we would love to work with you. Additionally, before you leave my channel, I ask that you please hit the subscribe button. Please like and share this video to help me increase the financial literacy of our globe. Thank you so much and have a great day.